You and I were at the same event last night. Steve Cohen was there, Mark Lasry was there, Michael Hintz was there. Everybody is talking about the Comey memo. What's your take?
It's clear to me that it's a very complicated issue. A lot of this is very partisan, but at the end of the day, an independent commission needs to be set up. And the sooner the administration can deal with this and get this behind us, the sooner they can move on with policy.
You want Congress to set up, appoint a special prosecutor, or at least
a commission to investigate whether a prosecutor should be brought in or not, because we need to get this matter as a country behind us, one way or another. And the sooner the administration gets this question answered, whether there was influence and whether there's obstruction, the better for the administration, because the administration has a lot of very good ideas on tax, a lot of good ideas on regulatory relief, and I think that it's going to make the case for that occurring harder if this isn't dealt with sooner.
Regardless of your politics, not yours, anyone's.
Yes.
You want to have faith in the president. You want to have faith in the White House. Do you still have faith in the president? Do you still have faith in the White House?
It's hard to separate as a independent person that tries to be objective. What's fake news? What's partisan? And what's real? And so none of us in the press and none of us, I think, in the markets yet know what is fake and what is real.
You don't believe
and what is real.
Hang on a moment. You don't believe what we're hearing about this memo is real?
I just don't have enough to judge yet. That's why I think you need a commission and you need a testimony by Comey in front of Congress, whether it's in private or whether it's in public,
that's a fair point.
To really be under oath as to what's being said, because there's a lot of things that get said that aren't necessarily the case.
Let's assume for the moment that the memo is real.
Okay.
Treat it as a hypothetical. Where do you come down?
I think you have to take it within the context. So if the president were to obstruct an investigation by the FBI, that would be a very serious matter, a matter that obstruction of justice we've dealt with in this country before from the White House, and so I think we need to know more information at this point, and I think we need to be very objective, which is why you need an independent counsel to investigate this matter. And it's best for the administration to embrace that, to get that behind us, to get these questions behind us, so they can move on with the policy measures of what is going to make this country a stronger country from an economic policy perspective.
Some of the people in the White House are Wall Street people, and in the president's cabinet, right?
Yes.
Gary Cohn, obviously Wilbur Ross, Steve Mnuchin, Craig Phillips, for example, whom I'm sure you know from his work in the mortgage market. Do you worry that these guys are getting a little bit skittish about the amount of political risk that's being attached to their careers and beginning to ask themselves questions about how much longer they stay in the White House or in that circle?
No, I think they're needed more than ever at moments like this, because it's a steady hand that comes from a Steve Mnuchin, who's a very fine Treasury Secretary, and Gary Cohn, who's a brilliant manager and brilliant mind when it comes to economic policy. And that's what this country needs. They need them to be steady. And remember, both Steve and Gary were Democrats and registered Democrats, and they joined the administration. And they joined not necessarily because of the president per se, but their commitment to the United States of America to make this country the great country that it is. And they're aligned with the president, but it's not clear to me that just because the president has some questions to answer, that they're going to jump ship. So I think that's a big jump from where we are now, and I'm not there at all in terms of where I think this comes out. As it relates to the people that come from Wall Street that work in the administration.
The financial markets so far have been resilient, and investors have appeared to be disinterested in the turmoil in the White House. Today, however, stocks are off, the dollar's down, there's a strong bid for treasuries. What signal does that send?
Well, that's important. I mean, this Trump trade that we've all embraced and that has driven the markets to new highs in equities is coming to an end here, because the
Trump trade's coming to an end.
The rose is off the bloom, so it may have to be,
or blooms off the rose,
or blooms off the rose. So it may have to be that that we need to get through this so we can see whether we can get these policy measures through.
Is there a new Trump trade?
Well, it'd be a retracement of where we rallied to, and that's the risk, is how much equities have rallied on this, and the kind of the confidence and flow of capital into this country. Now, Europe, on the other hand, is getting enormous flows of capital at the expense of U.S. equities, I think, on a go-forward basis.
Really?
As it relates to this trade.
I mean, we haven't seen that yet. We've seen economic recovery in Europe. We've seen Macron beat Le Pen, but you're saying that now equity market's going to sell off and capital flows are going to steer toward
I think
Europe?
the equity markets are starting to flow a little bit more towards Europe because the equities are undervalued. Look at Barron's this week. Buy Europe. It's undervalued. Front page. Cover page.
Even after rallies of, what, 14% in Spain, for example, and double digits in France and double digits in Germany?
The political situation, Brexit aside, has stabilized in Europe between Macron's election and between what we see in Germany. And so we think it's going to be a very stable place to invest. And, Marathon's benefited from that because we bought a lot of non-performing loans out of European banks over the last many years, put billions of dollars to work there. And this new flow of capital and the improved economic situation in Europe, because the economy in Europe is accelerating from 1.6 to 1.8, potentially 2% GDP. But I think we'll start to see capital flows move a little bit more towards Europe as the euro rallies relative to the dollar on, say, this move, and as the equity market in the U.S. has rallied so much relative to European equities, leaving European equities a bit undervalued. So it could be a relative value trade that becomes the, quote, Trump trade.
Okay, but you're an opportunities guy, so
yes.
You need to be a counter-cyclical investor. You need to think that way. If, in fact, that happens, capital flows towards Europe, raises the value of the investments that you have.
Yes.
U.S. markets or assets in U.S. markets lose value. Does that make you more interested in the not-too-distant future in what's on sale here?
Well, it's way too early for that because when it comes to the credit markets are rather stable. High yield is rather low rates. And so we need to see a pretty significant sell-off in the high yield market. Having said that...
let's talk about that for a moment.
Yeah.
Spreads are what, 350, 360 right now?
Well,
high yield credit spreads?
For high yield, if you look at it default adjusted, if you look at the nominal yield, you're talking about 5.5%.
Right. And you get interested at what point?
And we get interested back a couple hundred basis points, 7.5 and 8%.
We're a long
for
way
high
from
yield.
that.
A long way from that. But you have certain sectors in the U.S. high yield market that are under a lot of distress right now, such as the retail sector.
Yes.
And you have certain retail bonds that are trading at par, and the equities are off 30%. And you take a company like Macy's, who has a lot of real estate and only leveraged 2 times. And so it's more of an equity earning story than it is a debt story because the debt trades at par. And then you take a company, that maybe stock is down. Sears, stock is down 40% year to date, and the bonds trade below 50 cents on the dollar. And so, yes, it's an earnings story, but it's also a credit story because we believe
it's a leverage
Sears
story.
Because it's 10 times leveraged, thank you, debt to EBITDA, and we think that over time it will be forced to bankruptcy and will probably end up in liquidation at some point because we don't think it's necessarily an ongoing concern.
So I just want to understand what you're getting at here. Those stories are stories you like, where there's a high degree of leverage.
Those stories are stories right now in the high yield market that, despite very tight high yield spreads, are playing out.
Yes.
And will present opportunities later when you differentiate what companies are ongoing business concerns and for the debt have very good equity valuations.
Why later and why not now? They're not cheap enough?
It's too early to buy. I don't want to buy so far in advance of a bankruptcy because I think the bonds will go down significantly from here. You don't want to buy the equity because the equity will be scratched in some of these cases, and the debt will become the new equity, and the debt is too early to buy because it will deteriorate further.
We're talking about Sears and what else?
Say J. Crew, Rue 21 just filed, Payless recently filed, but we have our whole list, our shopping list of what retailers are the riskiest retailers and which ones will be ongoing business concerns, and which ones will be more Radio Shack-like, more Blockbuster Video-like, and just simply cease to exist. Yeah, and the big trade that people were talking about in the markets just recently was this whole CMBX 6 trade, where
this is the death of the mall trade.
The death of the mall trade. And what's turned out to be the case is yes, the bonds or the CDX has traded lower by a couple points, but the carries cost you at least that much, so you've made no money on that. The one dot to connect from that trade a few months ago was don't short the malls necessarily, or don't think those malls are going to be worth a lot less necessarily, because they could be repositioned in a lot of cases. The thing to short was the retailers, and that's what's gotten crushed. Those equities are down 30 to 40%, in certain cases 50% year to date.
Bruce, to bring it full circle,
yes.
With the turmoil in the White House, are you as an investor comfortable committing capital in American financial markets right now, or is it time to sit back and wait to see how this plays out?
We're deep value investors, and so I think that with high yield as tight as it is, we're raising more and more cash. Nothing to do with the administration. It has to do with credit spreads where they are. And with some of our distressed plays coming to fruition and paying out in the form of cash, we probably won't reinvest some of those proceeds, again, letting our cash pile up. As this Trump issue might, and I say might because I'm not sure which way this goes, might cause a retrenchment in the markets, that would play well because we do have some cash building up.